Are you tired of watching your hard-earned money sit idle, barely keeping pace with inflation, or worse, losing value in volatile markets? Do you dream of financial independence, a comfortable retirement, or simply having your money work for you, rather than you constantly working for it? If so, you've likely considered investing. But the world of investing can seem daunting, a labyrinth of jargon, complex strategies, and endless choices. Where do you even begin, especially when the goal isn't just to invest, but to invest wisely, building a resilient portfolio that can weather any economic storm? Today, we're going to demystify one of the most powerful concepts in investing, diversification. And we're going to show you exactly how to implement this crucial strategy using a platform that's gained immense popularity for its user-friendliness and comprehensive offerings, Ally Invest. This isn't just another theoretical discussion. This is a practical, step-by-step guide to building a diversified portfolio that aligns with your financial goals, risk tolerance, and time horizon. Before we dive into the how, let's spend a moment on the why. Why is diversification so critical? Imagine you're a tightrope walker. Would you rather have one thick rope beneath you, or a dozen thinner ropes spread out? If the single thick rope frays, you're in trouble. But if one of the dozen thinner ropes snaps, the others are there to support you. That's diversification in a nutshell. It's about spreading your investments across different asset classes, industries, geographies, and even investment styles, so that the poor performance of one investment doesn't derail your entire portfolio. It's about reducing risk without necessarily sacrificing returns. Think about it this way: the stock market can be a roller coaster. Some days it soars, others it plummets. If all your money is in a single stock, or even a single sector, you're highly exposed to its individual ups and downs. But what if you own a mix of stocks, bonds, real estate, and even some alternative assets? When stocks are down, bonds might be up. When the domestic market is struggling, international markets might be thriving. This natural counterbalancing act helps smooth out the ride, providing a more consistent and less stressful investment journey. Diversification isn't about eliminating risk entirely. That's impossible in investing, but it's about managing and mitigating it effectively. It's your financial safety net. Now, let's talk about Ally Invest. Why choose Ally for building a diversified portfolio? Ally has evolved from primarily an online bank to a full-fledged financial services powerhouse, and Ally Invest is their brokerage arm. What makes them stand out is their combination of competitive pricing, a wide range of investment options, and a user-friendly interface that caters to both beginners and more experienced investors. You get access to stocks, ETFs, mutual funds, options, and even Forex, all within a single platform. Their commission-free trading for U.S.-listed stocks and ETFs is a major draw, allowing you to rebalance and adjust your portfolio without incurring excessive fees. Furthermore, Ally provides a wealth of research tools, educational resources, and responsive customer support, which are invaluable as you navigate your investment journey. They also offer robo-advisory services if you prefer a more hands-off approach, which we'll touch upon later. So, how do we actually build a diversified portfolio on Ally? Let's break it down into actionable steps. Step 1. Define your financial goals and risk tolerance. This is the absolute bedrock of any successful investment strategy. Before you even think about buying a single stock or ETF, you need to understand why you're investing and how much risk you're comfortable taking. Financial goals: are you saving for retirement in 30 years? A down payment on a house in 5 years? Your child's education in 10 years? Each goal has a different time horizon, which directly impacts the type of investments you should consider. Longer time horizons generally allow for more aggressive, growth-oriented investments, as you have time to recover from market downturns. Shorter time horizons call for more conservative, capital-preserving strategies. Risk tolerance: this is deeply personal. Are you the type of person who loses sleep over a 10% market dip, or do you see it as a buying opportunity? Ally Invest, like many platforms, offers questionnaires to help you assess your risk tolerance. Be honest with yourself. An aggressive portfolio might offer higher potential returns, but it also comes with higher potential losses. Investing beyond your comfort level can lead to panic selling during downturns, which is one of the worst mistakes an investor can make. Understand your psychological relationship with risk. Once you have a clear picture of your goals and risk tolerance, you can move on to asset allocation. Step 2. Determine your asset allocation strategy. Asset allocation is the cornerstone of diversification. It's the process of deciding how to divide your investment portfolio among different asset categories, such as stocks, bonds, and cash equivalents. This decision is far more impactful on your long-term returns than trying to pick individual winning stocks. Stocks, equities. Historically, stocks have offered the highest long-term returns, but they also come with higher volatility. They represent ownership in companies and are generally best for long-term growth. Bonds, fixed income bonds, represent loans to governments or corporations. They are generally less volatile than stocks and provide a steady stream of income. They act as a ballast in a portfolio, providing stability when stocks are turbulent. Cash equivalents, these are highly liquid, low-risk investments like money market accounts or short-term CDs. They offer very low returns but provide safety and liquidity. They're good for emergency funds or for capital you might need in the very near future. A common rule of thumb for asset allocation is the 110 minus your age rule for your stock allocation. So, if you're 30 years old, you might consider having around 80% of your portfolio in stocks. 110 minus 30 is equal to 80. The remaining 20% would be in bonds. This is just a guideline, and you should adjust it based on your personal risk tolerance and financial goals. A 25-year-old with a high risk tolerance and a long time horizon might be 90% stocks, while a 60-year-old nearing retirement might be 40% stocks, 60% bonds. Ally Invest offers various tools and resources, including their robo-advisor, Ally Invest Managed Portfolios, which can help you determine an appropriate asset allocation based on your profile. Even if you plan to self-direct your investments, these tools can provide valuable insights. With that said, thanks for watching, and until next time.